Okay, what I've decided to do is to go through chapter 18 before I look, and then save chapter 14 for next week, because chapter 14 really is a revision of the materials that we'll be covering up until this week. So I want to get chapter 18, which is completing the audit, finished, and then we can use next week for revision, and that can include chapter 14, because we are running behind a little bit. So the objectives this week are to describe the auditor's responsibilities with respect to events occurring after the end of financial year and the different types of accounting treatments of events occurring after the end of the financial year, which should be very familiar to you because you should have also been studying financial accounting regulation application, no, not application, theory, theory, yeah. So this shouldn't take too long for those of you who are just doing it. That's great. Those of you who did it last trimester, even better, you've already covered it. So we will also then go on and look at the issues about trying to ensure that the organisation is a going concern. Big issue for auditors, very dangerous issue and very subjective. And in addition to that, we need to make sure that the firm has disclosed all contingent liabilities. And wherever we're looking for something that's not there, it's much more difficult than testing something that is there. So if an organisation is trying to hide something from you, it's quite easy sometimes for them to do that. It's much easier for them to hide things from you than to put things in and justify them. At least you know what you're dealing with. So we'll look at some of the ways of getting around that. We'll introduce that management representation letter, a letter that needs to go out towards the end of the audit for the management. We'll look at analytical procedures that are important to do at the end of the audit. So analytical procedures, we do them right at the beginning, so we get an idea of what's going on in the organisation. We can use analytical procedures as substantive tests, and we use them at the end of the audit for an overall review to kind of, after we've made all the adjustments to the financial reports, we need to have a look at it again to see if there's anything that has come to light. And communicating with the entity, with the board of directors, if they need to contact ASIC about anything, if they need to let the members know anything, that all comes at the end of the audit. So we'll have a quick look at that too. Now, ASA 560 is the standard that deals with reviewing for subsequent events. And it gives the auditor some guidance on how to do this. Firstly, it says that it is the auditor's responsibility to look for subsequent events. And subsequent events are fall between the date of the balance sheet, the closing date, and the date that the auditor signs the audit report. So balance sheet date to the date the auditor signs the report is very important. So we've got to get our dates straight. If the events occur after the date that the auditor signs the report, there are still some responsibilities there, but nowhere near the amount that they have up to the date of the audit report. The audit report date really is the date that we say the auditor has done their job, they stop auditing. Stop asking questions, stop investigating. After that date, it's only if something actually comes to their attention that they have to do anything. They don't have to go looking for anything. So very important that you establish balance date and the date of the audit report. Now this table, I think, is very, very important. I could shift my face out of there. Maybe I can get rid of me altogether. That's better. I'd still like to move that little box. There we are. So in this diagram, we see the three important dates. The reporting date, generally 30th of June or the 31st of December, but it can be something different to that. It could be September or March. The date of the auditor's report, which is a month or so after reporting date, maybe up to 6-7 weeks after the reporting date. And then the date that we issue the financial statements, the date that they actually go out to the shareholders. Obviously, the date that the auditor signs the report shareholders don't receive their report immediately. Mind you, the time span has reduced significantly with electronic means. It used to be that you would have to send them off to the printers and then they get posted to the shareholders. Now a lot of that is done electronically, so the time frames are reduced somewhat. And auditors are pretty happy about that, because the sooner they get them to shareholders, the sooner they can forget about them. So I've got the date from the end of the reporting period all the way through to even after the financial statements are issued. Subsequent events can occur. That's because things happen after all these things occur. So the events can occur, and we've got to decide whether it's something the auditor needs to do something about or not. So we've got two periods here, the subsequent period and the post-audit period. The subsequent period is represented by number 1 down here in their legend. So period 1, the auditors have responsibility to discover and evaluate all subsequent events that may have a material effect on the financial statements. So whatever happens between reporting date and the date that the auditor signs the report is the auditor's responsibility to discover and evaluate these things. So they've got to actively be looking for things that might impact the financial statements. Once the auditor signs the audit report, see here this 1st of August in this example, we go into the post-audit period, and that's period number 2. Actually, it's broken up into periods number 2 and 3. Period number 2 is between the date the audit report gets signed and the date that the financial statements get issued, that they get sent to the shareholders. So period 2, the auditors have responsibility to examine only events that come to their attention. So if someone in the office finds out there's a media report that the factory that you just audited got burnt down, or the CEO just got charged with fraud, and it is brought to your attention, then you've got to do something about it if it's impacting the financial statements. You don't have to go out and find it, but if it comes to your attention, it's your responsibility to decide whether you have to report it or not. In period 3, so that's up to the date that the financial statements are issued. Once they are issued, the auditor, like 2, the auditor has responsibility to examine only events that come to their attention, but only events that occurred before the financial statements were issued. So the event had to have taken place in period 2. If the event took place in period 3, it's next year's problem. So if someone says, oh, the factory burnt down and it's the 30th of August, you go, okay, well, that doesn't affect last year's financial statements. We deal with it for the coming year's financial statements. Yes.
On those events, it's exist on the date of audit report signed, not those which come after the sign of audit report.
No, it can. If the event occurred after the audit report was signed.
After period 2, if something happened after period 2.
Oh, beg your pardon. Yes, you're absolutely right. That's right. So it's only for 3. I have to thank you for that. So I've got to correct myself there. For period 3, okay, so someone brings to my attention something that happened to this company and I've already issued the financial statements. It's only if it occurred in period 1. And I said period 2, I think, didn't I? Yes. It would be the same. That's right. It would be the same as 2 then. So I'll repeat that. If something is brought to my attention in period 3, that is, after the financial statements are issued, I'm only going to be responsible for doing something if that event occurred in period 1, because what that means is I should have actually picked it up during my audit of subsequent events, but I didn't. And it is an auditor's nightmare to go, oh my gosh, when did that happen? They go 30th of June, 30th of July. Go, oh no. Oh no, that would have been the 1st of August, I would say. Yeah, they would have it the same date. Yeah. Because everything's got to get printed and sent out and put together by then. This is the issue date is the date that it becomes available to shareholders, or it gets posted if you're using a postal system. If you're using an internet-based system, the date that it gets put up on the internet. Okay, so those 3 periods are very important. Read this slide carefully, and it is something that I would suggest you make sure you've got a copy of in the exam so you can work things out. So be aware of those things.
Smith,
yes.
In my opinion, what I wrote in my I saw that table when I was documented, but the case of Dick was very specific.
Yes.
I mean, I cannot say that straight away. Oh no, okay, because everything happens after in the period 3. No, now they are relieved, or period 2, then relieved, because many big things they should be aware during the period 1.
Right. So, and that's their big worry. What can they defend? Is it due to negligence? If it was due to negligence that they didn't find these things out, then they're going to have a case to defend. If they were not negligent, if it did occur in period 1, okay, so in period 3, after the statements are issued, we find out, oh my gosh, Dick Smith Electronics got broke, can't pay its debts. Hang on, auditors, you should have seen that, because there were lots of things that happened before you signed the audit report that you didn't know about. That's where the auditor would have to say, yes, but we were not negligent. We did pursue this, and we did look at that, and we did this. It just so happened it didn't come to our attention.
And another consultant got $180 million. The another consultant, the external consultant, proposed an adjustment, but they say, okay, no, let's take $60 million.
Yeah.
It is such this unbelievable.
Yes, it is. It's amazing.
Yes, there were 3 times more.
Yeah. So now you can understand all this much better, can't you?
Yeah.
With all of this. Yeah. So these are the issues. Now, the accounting considerations. We need to go back to our accounting. This is why you do need the information from your financial accounting, AASB 110, events after balance sheet date. And we've got 2 types of events. Are they an adjusting event or a non-adjusting event? This is what we have to decide. So we'll do a little bit of a recap.
Okay, you can ask this one.
Okay, I can ask this question. Okay, so we've got adjusting events are those that provide additional evidence about conditions that existed at balance date, but there might have been uncertainty surrounding them at balance date. So they're providing evidence of things that existed at balance date. So the event occurred before or after balance date, and it confirms something I might have been unsure about at balance date. An example would be if I have a shipment of goods and I've included them in inventory at their cost price, and after balance date, it comes to our attention that they've actually gone rotten and they're worth nothing. As long as that condition existed at balance date, they were rotten at balance date, then that's an example of an adjusting event. We thought they were all right, but actually they weren't. We got the test results back, 3 weeks later, because that's how long it takes to test this particular chemical or whatever. And we find out that it's worthless. That's an example of where we would have to adjust the financial statements. The condition existed at balance date, the inventory was in that condition, but we didn't realise it.
This is the form I have this analysis, this application of the system.
Well, this is the auditor. The auditor is checking to see if how they've handled these things. So when they found out that the goods were worth nothing, what did they do? If they didn't write down the inventory to the realisable value, then the auditor would be saying, you need to do this because this is an adjusting event.
Like if you're not recording the inventory or load of NRV or NRV or cost, so is it adjusting event or not even?
It's an adjusting event, provided the inventory was in that condition at balance date. Mm. So there could be two things. All right, if I've got perishable goods, I deal in perishable goods, lettuces. I grow lettuces. I'm an agricultural business, and I have containers and containers and containers of lettuces in my cold room. I value those lettuces at cost or net realisable value, whatever it is, at balance date, and I say I couldn't sell these lettuces. You know, no, okay, let's not go there. Let's say they're valued at $1 each, and that's how I have always valued them. And on the 5th of July, the auditor's doing a little walk around and sees that there's, smells a bad smell coming from this particular cool room. And they go in and go, oh my God, all your lettuces have gone rotten. We need to establish, did they go rotten after balance date or were they rotten at balance date? If you go in there and they're all slimy and all that, you go, oh, this has been here for a long time. These have always, you've had the air conditioning turned off for 2 weeks. These were worth nothing at balance date. Then it's an adjusting event. If, however, they became rotten after balance date, it's not an adjusting event. Okay, so timing is important. Yeah. Oh, that's right. You're going to adjust everything. You never finish. Okay, so it's providing additional information to management and auditors regarding valuations of accounts. We require an adjustment of account balance if the amounts are material. Remember, this is only for material items. And some examples are if a major debtor goes bankrupt. Now, generally, people don't go bankrupt overnight. It happens over a period of time. So they were probably unable to pay their debt before the end of the financial year. If there's settlement of litigation at a different amount, you might have had something in there as a contingent liability, a legal case against you, contingent liability of $1 million, and then you end up with a finding that makes it $2 million. You've got to adjust that. Disposal of equipment below current book value. So you had it on the books at book value and then you sold it in July for half of its book value. Well, that means the value of that equipment was less than book value at balance date. It's not going to just go down overnight. So they're just some examples of it.
Is it impairment? The last one is not impairment?
No, it's not.
And any impairment after?
No, because you've sold it. Yeah, you've sold it. So it's not impairment. You haven't kept it. Yeah, but maybe you should have impaired it. At balance date, it should have been impaired. Should have been subject to impairment. When did the destruction occur?
It's the same like destruction.
Is this a block? Sorry, a
No.
A flood?
Yeah, like
No, but the flood we cannot.
When did the flood occur?
But it's no. But
so the condition didn't exist at balance date. Okay, we get to that. We get to that. Non-adjusting events. We'd now talk about a non-adjusting event. Those events that provide evidence of conditions that arose after the date of the financial report and therefore require no adjustment to the figures in the financial statements. And in which case we disclose it in a note. So if there was a flood after balance date and it ruined everything, we disclose that in a note to the accounts. In the example of the lettuces in the cool room, if it happened on the 3rd of July that the air conditioning got turned up or off or something, and the lettuces were ruined after the 30th of June, disclosure in a note. And of course, management would be saying, yeah, it happened after balance date. If there's evidence to support that, then you accept it. If there isn't, then the auditor has to decide whether they're going to. Yeah, yeah. What else do I need to say about that? Okay, so when we're looking at non-adjusting events, they're new conditions that arise after balance date. So we can't go back and change the numbers at balance date, but it's important information for shareholders to have. And remember, the purpose of financial reports is to give stakeholders information on which to base their decisions. And this is material information. It's going to impact their decision making. But we just have to know how we deal with it. And some examples: decline in the market value of securities, if we issue bonds or shares, decline in the market value of inventory, uninsured loss of inventory from fire, or a merger and acquisition. All of these things, if it occurs after balance date, you provide information in a note to the accounts. Now, considering the appropriateness of the going concern assumption, this is one of the things that the auditor has to consider towards the end of the audit, just prior to when they're going to be issuing the audit report, because dates are important. The auditor is saying that they believe the entity is a going concern and that it will be until the next audit. Okay, so they have to leave this for as long as they can, although it's in the back of their mind the whole time, and they're doing tests regarding this all along. But they've got to make a statement about the following 12 months. So the auditor needs to consider the appropriateness of management's use of the going concern assumption. Now, some of the indicators for a going concern problem, there could be a material operating loss. You know, they find out they've made a huge operating loss this year, and the prospects don't look good for the future. If key management personnel have left, in some organisations, the success of the organisation does hinge heavily on the CEO or the chairman of the board or someone like that. So they need to consider that if suddenly the whole board resigns, there could be a problem. Or there could be a change in legislation that impacts the organisation. So the auditor needs to consider all of these things. Towards the end of the audit, again, the partner in charge would sort of sit back and consider everything. The period to be considered by such assessment extends to the expected date of the auditor's report for the succeeding financial reporting period. So that is about a year. Now, I've got a note to myself here that the appendix of ASA 570 is excellent. So I suggest you go to that appendix and have a read. Because in ASA 570 in the appendix, it provides some guidance to the auditors on the audit report they need to issue. All right, so where there is material uncertainty and management haven't disclosed it, you've got to have an unqualified report with emphasis on matter. If there's material uncertainty and it is, if there's material uncertainty and it is disclosed by management, then you have a unqualified report with emphasis on matter. depending on how improbable it is. So let's have a look. If we're going to have a qualified audit report if we have material uncertainty and management don't disclose it. So there's material uncertainty about going concern, management refused to disclose it, then the auditor has to issue a qualified audit report, disagreement with management. If management says, okay, we will disclose it, don't want to, but we will, then the auditor gives an unqualified report, but with an emphasis on matter paragraph. And if it's highly improbable that the entity will continue as a going concern, the auditor has to issue an adverse opinion. So the difference between the qualified and the adverse is the level of uncertainty. So have a look at Appendix 1 in ASA 570. Sets it out very clearly.
How about if the company, because, well, I have seen recently a real case, about a company when I saw the statements, looks the company has many problems with the cash, has pretty much the material operating losses and decreasing of collection of debtors.
Yep.
But they are saying that there is no problem with going concern because they are relying on the parent company.
Yes. So
they don't have borrowed loans, bank accounts, just they are receiving money from the parent company.
Yes.
Is that okay? They are assigning letters every 6 months to refinance that kind of injection of cash. But yes, and the auditors,
yes.
I haven't seen the opinion yet because I saw the draft. This is in my new job.
Okay.
And then they say, okay, but yes, everything else they are documenting everything because I matched with the Dick Smith case. And okay, I got after finishing the assessment.
Okay.
Getting this one, I did exactly. Okay, no, I mean, but yes, it's very interesting because they are saying they have support from the parent company, which is an overseas company. So every time that they need cash, they give the injection of cash. But it's very difficult because the company is managed by projects. It is by services.
Yep.
So
you have to go back to the definition of a going concern. And a definition of a going concern is, can the company pay its debts when it falls due?
Okay. Even though if this is a parent.
And if they say, it doesn't matter that we're making losses now, things are going to come good in the future. We know the market's going to go up. We know this is going to improve. We know that's going to happen. And don't worry about the loss of cash because the parent company is going to support us every time.
Yeah.
And we'll get letters of guarantee from the parent company.
Yeah. That's okay.
Then the auditor has to go, okay.
That's okay.
That is okay. The auditor would be worried about it though. Yeah. I can tell you I was involved in a situation similar to that once, and we talked the auditor into giving us going concern. I was not the auditor. I was on the other side of it. I was actually the company secretary, and it was a mining company, a small mining company, and the cash was running out. The gold price kept going up, and all the expenses started to go up. And we couldn't get the gold crushed at the crushing plant because there was such a big queue. Everybody was going to crush it. So the cash started to run out. And the directors convinced the auditors that it was all right because there was another body that would provide the cash, that would be supplemented by something or other. And I was sitting there, I was very young at the time. I think I was in my early 20s. And I'd never seen anything like it before. Yeah. And these negotiating between and the arguments and the personalities of people, how important that is, how convincing and persuasive can you be? And they said, no, it's fine. We've got this in the background. That person's going to guarantee it, da-da-da. So the auditor said, okay, we'll sign off. 3 months later, ran out of cash. Went broke into liquidation. No, because it wasn't actually a parent company. It was an individual who agreed to sponsor them, but there was no signed agreement. The auditors caved in, really. The auditors caved in under the pressure by the directors and the persuasiveness of the directors. They shouldn't have. With hindsight, I look back now and think, wow, that was a bit too easy. But I wonder how often that does go on. I mean, auditors are very reluctant to claim that the company is not a going concern because it's a death sentence for the company. Who's going to give them credit? Nobody. Who's going to buy shares? Nobody. Customers, they're going to change to someone else because they don't want, they're afraid that this company is going to go broke. They won't get their orders or this sort of thing. So the auditors are very reluctant to claim the going concern uncertainty.
Also as a customer.
Yeah.
It's very difficult to say, oh, no, you are going to die.
Yeah, that's it. That's it. That's it.
So in this case, something is coming to my mind. Auditor can ask for a parent company, like as an evidence.
Yes.
You're going to support. So
yes. So a written guarantee.
Yeah, there is interest.
Yes.
I mean, everything is documented.
Yes.
Unless, because I started yesterday.
Oh gosh, you started yesterday.
I have read it.
Are you going to go? No, you're gone. So you're putting on your auditor's hat though. That's good. I'm happy. See, you're thinking like an auditor. I've achieved my objective. That's all I want. I want everyone to think like auditors. Okay, moving right along. So we've got that. Okay, another job that we have to do in as completing the audit, because remember this section is called completing the audit. It's not just about subsequent events. It's not just about going concern. It's also about reviewing for contingent liabilities. Again, there's no point me doing this too early in the audit because things will keep occurring on the way through. Right towards the end, I've got to again stand back and look at potential contingent liabilities. Have I learnt things, heard things, seen things that suggest to me there could be a contingent liability that isn't being declared? So I have to look, is there a potential future obligation to an outside party for an unknown amount resulting from activities that have already taken place but are conditional on some future event? So is there something the organisation might be liable for? Might not know exactly how much, but it depends on something else happening. That's what I'm looking for here. Very difficult. And some examples are pending legal action. So but there's something in court that needs to be decided, but it hasn't yet been decided. Are there income tax disputes? That can be one. That's quite common to have income tax disputes where the Australian Tax Office refuses a deduction, a claim, and then the client challenges that. So it goes to a board of review and they're waiting for an outcome. That's quite common to have a contingent liability for that. Product warranties, guarantees or obligations of others. So if you are the parent company and you've guaranteed to support the subsidiary, that's got to be on your books as a contingent liability. Any unused balances in letters of credit that might be sitting there and people haven't claimed yet. So they're the sort of things that we need to look out for. And again, we go to the accounting standards, AASB 137 and 101. So back to your financial accounting. And this little diagram, it says, remember FA2, it's not actually FA2, that's financial accounting 2. It was in another university I worked at. I keep forgetting to change the slide. But the story is the same. We start up here and we ask the question, is there a present obligation as a result of an obligating event? Okay, so an obligating event, is there something that's happened that's made me liable to something, for something? If the answer is no, then I have to say, is there a possible obligation? If it's no, then don't do anything. Come back here. Is there a present obligation as a result of an obligating event? No, but there could be a possible obligation. Is that obligation remote? If the answer is yes, do nothing. If it's not remote, and I mean, you can see the subjectivity of this, that we're trying to decide, is it possible? Is it probable? Is it remote? If it's remote, if it isn't remote, but there's a possible obligation, and yeah, that could happen, it's not unforeseeable, then we disclose it as a contingent liability.
Like, we can have anything, is there any past history about this sort of
Yes,
activity?
yes. And all the things that you pick up in the organisation, the activities that are taking place, the relationships that they might have with other organisations, and if it is a group of companies or a loosely associated joint ventures, things like that, if they're entering into other activities like that, then this becomes really important.
So you're paying money.
Yeah, that's fine. So is there a probable outflow? Is there a reliable estimate? If there is a reliable estimate and it's probable that we're going to have to pay it, then you make a provision. It goes in the balance sheet. If there can be no reliable estimate, then it's a contingent liability. So that's not a bad decision tree. So is there a present obligation as a result of an obligating event? Yes. Is it likely you're going to have to pay out some money? Yes. Is there a reliable estimate? Yes. Put it in the balance sheet. If there's not a reliable estimate, it's a contingent liability. You can't just leave it off completely. It's important information, and of course, with all of this, we're only talking about material items.
And even with the assets, we should disclose the assets.
That's right. That's right, you have contingent assets.
Yeah.
Yep. All right, audit tests for subsequent events. So how am I going to find out these things as an auditor? ASA 560 has some really good advice. They've got lots of descriptions of things that the auditor can do. So you're going to make inquiries of management. You ask them questions. You ask them direct questions about these things. Is there anything you haven't told me? Do you have any, and in their questionnaires, the larger firms will have the questionnaires with set questions to ask. Have you entered into any guarantees or, sort of informal agreements with people about whatever? You would look at correspondence with lawyers. If they're constantly, if they're paying lots of legal fees, you'd be wondering what they're paying legal fees for. So you go and find out, what are the lawyers doing for you? Are they trying to get an agreement with you and this other organisation for something or other? Do I need to know about this? Is there a potential for a liability? Is there an obligating event associated with this? And if so, I start asking those other questions. Has there been a major changes in the business or the environment? Review records prepared subsequent to balance sheet date. So after balance sheet date, what are they working on? What are they doing? I'm finding out what's happening in the offices. Are they entering into other agreements? Is there discussion around the place about something I should know about? So what takes place after balance date while I'm sitting in their office, preparing their auditing, doing the audit? This is where my ears and eyes are open. You examine minutes of meetings, directors' meetings and management meetings that have been issued subsequent to balance sheet date. And subsequent is after balance sheet date. Have a look at any correspondence with the Australian Tax Office. So they would have, if there is a potential liability, there will be correspondence pertaining to that. And you obtain a letter of representation. And this letter of representation is prescribed by ASA 580. And this is where you're really asking management directly if there are things that you should know about that they haven't brought to your attention.
If the company doesn't have lawyers?
They don't have lawyers? Well, then that's one avenue that you're not going to have then. I mean, they might not, and so it could be quite easy. They might not get into complex agreements and things. So if you look in the expenses for the year and there's no legal fees, okay, chances are they're not really doing anything that you need to worry about. Whereas if there are lots of legal fees, you'll know that they're engaging lawyers for something. You need to know what. Okay, we said also that we're going to do some analytical procedures towards the end of the audit. And the analytical procedures are really to assure us that once we've made all the adjustments to the financial statements, because as you go through and say, oh, you've overvalued your debtors, I want you to write them down by this much, or your inventory should be valued at this, or there should be a contingent liability there, you've classified this as an asset, actually it should be an expense, and you have this trial balance of changes. You have the original trial balance of the company, then all of the proposed changes by the auditor, and the final financial reports. I've got to do my analytical procedures again to see what it looks like with the changes that we've made. So I go through all of that, and I'm looking for anything that doesn't look right. At the same time, I want these ratios to support my conclusions as well. So I'm hoping that after I make all these changes, I do the ratios and they look acceptable. You know, that reasonableness test that we have. They also assist me in arriving at my overall conclusions. It tells me if all the information and the knowledge that I have about the entity is consistent with the numbers they're presenting to me. And it will also give me some assurance about the going concern assumption. So I use my analytical procedures to confirm, to either support or corroborate my conclusions or refute them. And if they don't turn out right, then I go back and I start looking for more reasons, more things that might be wrong. So in my final procedures of accumulating evidence, I'm going to obtain that management representation letter. And that management representation letter is an explicit request of management to sign. You're asking them to sign a letter where you outline all the things that you've asked them and they've told you, all the significant things you've asked them and they've told you, and then they sign it. So it's very easy for someone to say something. You know, are there any outstanding legal issues for the company? No, nothing. Now, if I can answer that quite freely in a meeting, that's fine. If someone says, okay, can you please sign this piece of paper declaring that I asked you this question and you answered that there was nothing outstanding. You just want to have a think about that. Okay, very important. So it's very explicit. And it also stresses to management that they're still responsible for all those assertions that they're making about the financial reports. That just because you've had an audit doesn't mean you're no longer responsible for this. You are. The directors are still responsible for the financial reports, and having an audit doesn't take that away. So this management representation letter makes all of that clear. And you would often have a meeting at the same time that you present that and explain the letter to them. What have I got? Reading other information accompanying the financial report. So the other thing that you're going to do towards the end of the audit is read the director's reports, the chairman's address, the segment reports, all the other pretty pictures and the lovely stories that they tell in the annual report, and see if that actually matches to what you know about the company and what the financial reports are saying. Because they might talk about, oh, we've had a wonderful year and sales have grown by 80% and we've been able to cap our expenses this year. You go, hang on, sales didn't grow by 80%. No, you can't say that. So you're also responsible for what else goes into the financial reports. So you need to read it and make sure that it is consistent with what's being reported on. And then you're going to evaluate your findings. So you've got all of your evidence, you've read all the other materials that are going in the report. we need to evaluate what we find. So what the audit partner needs to do is to, after they've looked at all the working papers, they want to ensure that the audit process has complied with auditing standards. They look back, are we compliant with auditing standards? Are there any gaps? Is there anything that we've missed? Have we reviewed all the working papers properly, the most senior person? Have we checked everything we need to check, etc.? And then I'm going to determine the type of audit opinion I'm going to express. Hopefully it's an unqualified opinion, but it comes down to that decision. I've got to evaluate the findings and see, is there anything that I need to emphasise? Do I need an emphasis on matter paragraph? Is there any qualification I require for this audit at all? Have I been able to collect sufficient appropriate evidence? Okay, so the auditor needs to make the final assessment of materiality and audit risk, undertake a technical review of the financial statements, a final review of the working papers, and formulate an opinion and draft the audit report. So to achieve that objective, to come up with that opinion, that's what they need to do. And to be satisfied that they have met all of the auditing standards. They're the sort of things they need to do. And then there's some communications that they have to carry out. Some of these will take place during the audit and others will take place at the end of the audit. So we're going to communicate any irregularities, including fraud or other illegal acts, during the audit. We don't leave it till the end. So you can't go, oh my gosh, fraud's occurring, but I don't need to do anything about that yet. I'll wait till I do the audit report. They're the things that you need to communicate all the way through, as are the reportable internal control deficiencies. So if you look at internal controls and go, oh my gosh, they are so susceptible to misappropriation of assets or material misstatements, you don't wait till the end, you do it as you're going along. Communicate auditor independence requirements. That's part of the financial reports, and it's required as part of the financial reports. And the management letter containing recommendations from the auditor to the management. So the last two we communicate towards at the end of the process, but the first two we have to communicate as we're performing the audit. I've got these standards next to each of those, so it might pay to have a look at those. And then I produce the audit report. And keep in mind that where an auditor disagrees with what the company's doing in terms of accounting treatments, they request those changes to be made. So they say, no, your inventory is overvalued. According to our figures, inventory should be adjusted by this amount. Mostly, the client makes the adjustment because the client wants an unqualified audit report. They might make part of an adjustment. They might go, oh, no way, you know, you've said that we've overvalued by $100,000. We haven't. These things are all okay. These I'll agree with, and this is where negotiation comes into. I don't agree with that, but I agree on that. So management will try to get it down to an acceptable level so that it comes within the tolerable error. So they might not agree to the whole adjustment, but they might agree to part of it. Because they know what auditors do too. They're not silly. So they go, okay, we'll modify it so that we keep within the tolerable errors. But it's only where management doesn't amend the financial statements that we have to issue a modified opinion. Okay, and now we go back to where we started here, the subsequent discovery of facts. If an auditor becomes aware after the audited financial statements have been issued that some information included in the statements is materially misleading, the auditor is obliged to inform statement users that they may decide to reissue the audit opinion. If they are not, they must seek to prevent reliance on the current reports. I'll just have to read that again. The auditor is obliged to inform statement users that they may decide to reissue the audit opinion if the financial statements are amended. If they are not, they must seek to prevent reliance on the current reports. Yeah. That's right, to the users, to the shareholders. That's right. There's an error in the financial reports, but we're going to correct it. And if the directors go, hey, hang on, no, we're not going to correct that, then they have to say, don't use the financial reports. And that's all. There's a fair bit, but hopefully it is going over mostly material that you've done in your financial accounting, but you now have a good idea of the role of the auditor post-balance date and before they sign the audit report, the sort of things they have to be watching out for, and have some appreciation for the difficulty in finding this information. And this is where the expertise comes in, for an auditor to be able to ask the right questions, look for things, be aware when something might point to an anomaly, and then know what they need to do. Because if you suspect something, you don't just rush and go, oh gosh, this has happened, we need to declare it. You'll need to get more evidence. So if it's something about an event that occurred after balance date that changed the value of an asset, one of the first things I need to do is establish the date that the transaction occurred or the event occurred. When did it happen? I need evidence to that. So I might have to get insurance reports or police reports. I might need to get confirmation from a supplier or a purchaser or something like that. So I firstly have to investigate it. So when my suspicion is aroused, I need to investigate it. I will make inquiries of management and outside parties. And then I do some calculations. Is this going to be material or not? And then I worry about whether we're going to make changes. I don't just jump in and say, oh, okay, we're going to change these things. So be aware of the sort of procedures that the auditor might need to undertake to find these things out and confirm that it is either an adjusting event or a non-adjusting event. Okay, do you have any questions? There are only 3 questions, 3 review questions that I've set. We will go through those next week and we will go through chapter 14. So 14 will be like our revision session. And I will give you time to ask any other questions that you might have as well.
Yeah, I checked the cover sheet of the exam.
Yes.
And okay, those topics, this is what we need to focus on.
Yes.
Specifically. So this is one of them.
Yes. I mean, I've given you a pretty good idea of what's in the exam. It's fairly predictable. You just have to be able to do it.
So I will, because I didn't see about the ethics. It's not covered there. I don't know. I didn't see. So we already covered
Yeah. But you need an understanding of ethics anyway. Like the first question, the nature of the profession or something like that. Or the audit environment, that covers your ethics and that sort of thing. You know, those early chapters. It's just a small amount on there. Yes. Okay, so I'm going to stop sharing the screen and I'm going to stop recording. So I hope I haven't had any feedback from people listening to this, so I don't know if they are or they aren't, but I would like to know if you do and if you can hear. So I'll stop.